This is the Nedgroup Investments podcast, where we explore a variety of views and insights that investors care about.
Good day, my name is Natalie Helmbold, and for today's edition of Nedgroup Investments Insights, I am chatting to Lara Dalmeyer, Portfolio Manager of the Nedgroup Investments Flexible Income Fund, which is part of our Flagship Fund Range. Thanks for being here, Lara.
Hi, Natalie. Thanks for having me.
So in this podcast, we will be discussing credit and risk management in income funds, as well as how we view credit in the Flexible Income Fund. So as investors, it's natural for us to focus on choosing an investment that will provide us with the highest return. And in the case of income funds, we'll go looking for the ones with the highest yield, but often not fully understanding the risk that comes with this. And this is especially so with income funds, where it's easy to assume that because it's an income fund designed to provide stability for drawing an income, that it will be safe. But not all income funds are created equal. There's actually a lot of dispersion in the multi-asset income category in terms of the risk that the funds are taking. When it comes to credit holdings specifically, many of the riskier instruments don't mark to market, which creates the illusion of this smooth return profile or less volatility, which is masking the true risk to the investor. So in this current environment, it's really important that investors understand what they're investing in, as often these funds are earning high yields and outperforming because of the additional risk that they are taking. So Lara, let's go to you. Can you start by taking us through how you think about risk management in an income portfolio?
Yes, so I think the first important point to note, and you alluded to it, is this dispersion within the multi-asset income category. This is not a one-size-fits-all category. The mandates and the risk tolerances within this category are actually very different. So when it comes to assessing risk management of a particular manager, the most important thing to do is, first of all, understand the mandate, understand what this particular fund manager is investing in, and what the different risk boundaries are. In terms of, what to assess, first and foremost would be the kind of interest rate risk that a particular mandate would take. Some managers have a higher tolerance for this, and others have a lower tolerance. Then there is credit risk. Some funds are more credit by nature. And it's just important to understand what kind of credit a fund is investing in. An easy way to assess this would be to look at credit ratings, would also be to look at the term of credit. And just the position sizing would be an important assessment. General liquidity is an important assessment for an income fund. Some property names can be a bit illiquid. Preference shares tend to be a bit illiquid. A lot of credit can be a bit illiquid. But there are some mitigating factors like term, like quality, which do improve liquidity in this market. But when it comes to assessing liquidity, naturally you need to look at that within the context of the overall portfolio. Another thing to look at would be the seniority of instruments that a particular fund manager would hold. A lot of debt is assumed to be senior, but it's also, worth noting that subordinated debt is available to fixed income managements as well as tier 1 debt, which does behave a bit more equity-like in nature. So what's important to note here is that these are not money market funds. They are taking additional risk, and some, by mandate and design, will take a bit more than others. It is not wrong to take, it is actually very right to take additional risk in order to generate alpha, but you need to assess the risk a fund manager is taking within the context of their mandate and within the description of the fund. And that's why I say it is very important for investors to know exactly the kind of fund that they are investing into, because like we mentioned, there is quite a big dispersion within this category.
And your general views on SA credit versus offshore credit, do you think that credit in South Africa at the moment, you're actually being compensated for that additional risk that you're taking on?
Unfortunately, lack of economic growth has translated into little credit issuance. Credit issuance in the local market is quite low, and there is certainly more demand than there is supply, and you can see that through the compression in credit spreads. My personal view is that for most of the local credit that I've seen, you are not being compensated for that risk. Offshore is a slightly different story. Although general credit spreads are not hugely attractive, it is such a wide and broad market that you are still able to find opportunities in that space. It used to be a lot of the local names that we know, Bidvest, for example, Prosus, they would issue offshore debt. And I think just because those names were slightly less known by offshore investors, you could certainly earn a nice premium of buying the dollar debt versus the rand debt, for example. But that is also a shrinking space, unfortunately. So the credit space is hard. It is expensive. My personal view is that there are better opportunities in other fixed income asset classes.
Okay, great. And then just bringing it back to the fund, the Flexible Income Fund is managed with a strong focus on risk management and protecting investors' capital. So in terms of credit in the portfolio, how do you guys look at it and how do you manage the risk around credit?
So I'll talk more broadly in terms of how we manage the fund and how we think of risk in terms of the portfolio. The Flexible Income Fund is on the conservative end of this spectrum of funds within the multi-asset income category. What the fund looks to do is to deliver about 2 to 3% in excess of money market funds over an investment cycle. But very importantly, we look to deliver this return by taking as little additional risk as possible. Yes, we have to take a bit more risk than a money market fund, but we will look to reach that target with as little risk as possible. We have a very strong focus and low tolerance for capital loss. We are mandated to have no capital loss over a rolling 6-month period. Internally, we manage that to 3 months. So we really looked for this fund to have no capital loss over 3-month rolling periods. I cannot emphasize enough this cognizance that we have around drawdowns and around this consistency of returns. So what does that mean in terms of how we actually manage the portfolio? The duration in the portfolio will generally be on the conservative end, and it will generally be well diversified across local and offshore names, linkers and nominal bonds. We have a conservative credit approach. We only look to invest in the top 60 or 70 names, all of whom will be well known to our Abax equity team. Those are local equity names. We also only purchase well-known offshore credit names. We do not invest in unlisted credit, sub-investment grade credit, unguaranteed SOE debt, or securitizations. Our position sizing, we believe, is prudent and we have very well diversified portfolio, and we do not take any equity risk in the portfolio, i.e. we do not invest in tier 1 debt, which we view as equity-like risk. So having said that, if you are looking for a fund that is going to be number 1 ranked when there is a massive bond bull market, then this is probably not the fund for you. But if you are looking for a fund with strong consistency in returns, a low drawdown tolerance, and with a conservative approach, then I think that this is a very attractive investment opportunity.
Great. Thank you so much, Lara, for all of your insights today. Thanks for giving us your time.
Thank you.
This podcast is for marketing information only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.